This is the Build Wealth Canada podcast, episode number 56.
Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hi, it's Cornell and welcome to the Build Wealth Canada show. So, house hunting season has officially begun, so I thought it would be a good idea to have an insider from the mortgage industry on the show to learn some top tips on getting the lowest possible mortgage rate, whether you're looking for a new mortgage or have one that you'll need to renew soon. Now, in the interview, we also look at what else you should look for in a mortgage in addition to just getting the lowest rate possible. In other words, what are the different clauses or contract terms that you should look out for when getting a new mortgage or renewing your existing one? And our industry insider and mortgage expert will tell us what sales and marketing tactics and tricks we should look out for from banks and other mortgage providers. Last but definitely not least, we discuss the pros and cons of the different ways that you can get your mortgage. For instance, do you use a mortgage broker? Do you go directly to a bank or credit union? Or do you just use one of the many mortgage comparison sites out there? So I'd like to welcome back Sean Cooper as our mortgage expert guest. He is now the best-selling author of the book Burn Your Mortgage, The Simple, Powerful Path to Financial Freedom for Canadians. He bought his first house when he was only 27 in Toronto and paid off his mortgage in just 3 years by age 30. These days, Sean's helping others burn their mortgage too as an independent mortgage broker. And in case you missed it, you can check out our previous interview together in episode 34, which is over at buildwealthcanada.ca/34. Or you can just use your podcast player to find that episode too. Now, before we dive into the interview, Sean has offered to answer for free any questions that you, the Build Wealth Canada listeners, may have. Now, I've set up a special page for him, so all you have to do is go to buildwealthcanada.ca/Sean, that's just SEAN, and there you can enter your email and Sean will be in touch with you and will be able to answer any questions that you may have. Now, he's a licensed mortgage broker too, so I definitely also encourage you to reach out to him if you're looking to get a new mortgage or if your mortgage is coming up for renewal, as at the very least, he'll be able to provide you with a short list of some of the best mortgages that he's been able to find all across Canada. None of this costs you anything, and there's no obligation to get your mortgage through him or use any of those suggested mortgages. So at the very least, you'll get some really good education on the top mortgages available in Canada. You'll get your questions answered by Sean as well, and you'll learn what to look for when choosing your next mortgage. And you can always decide later whether you'd like him to help you with the process or if you want to do it all yourself. But regardless of which path you take, it doesn't cost you anything regardless. And now, as a bonus, I'll also email you the mortgage checklist that Sean put together, which is a guide on the top things to look for and consider when choosing a mortgage. So instead of having to read a whole book on the subject, as mortgages can be pretty complex, this is a nice, quick, summarized checklist, but it includes all those key components that you really need to consider so that you don't accidentally miss something and then you get into trouble later down the road. So that link again to get in touch with Sean, get your questions answered, get the free mortgage checklist guide, and or get that research on some of the best mortgages in Canada if you're already shopping for a mortgage. Just go to buildwealthcanada.ca/Sean. That's buildwealthcanada.ca/Sean and just enter your email and Sean will be in touch with you and you guys can chat. And of course, I wanted to give a big shout out to Canadian Money Saver Magazine and EQ Bank for sponsoring this show and giving you, the Build Wealth Canada listeners, access to get a free 1-year digital subscription to Canadian Money Saver Magazine, Canada's largest personal finance magazine. It's a $20 subscription that you get for free as a Build Wealth Canada listener, and the magazine features Canada's top experts on personal finance and investing and is a great place to learn best practices and stay up to date on changes that will impact your investments and your financial situation for years to come, specifically here in Canada. Now, to get all that, all you have to do is open up a free savings account with my favorite bank and the bank that I personally use a lot, which is EQ Bank. Now, in case you're new to the podcast and haven't heard of EQ Bank yet, the reason that I personally use EQ Bank is that their savings account has one of the highest interest savings rates in Canada. In fact, in all the years that I've been with them, I haven't been able to find a higher interest rate anywhere. It's also free to sign up and keep an account with them, so you're not paying a monthly fee like you do with many of the other banks out there. And now you also get unlimited free Interac e-transfers as a bonus. So because of those reasons, I've been with them ever since they launched in Canada years ago. And it's where I keep my entire emergency fund and spending money. And I mean, we're in retirement now, so we actually keep a pretty sizable cushion of money just in case the markets are down, that kind of thing. And I literally keep it all with EQ Bank just because the interest rate is so high. So I might as well be earning some money while it's sitting there. All right. Now, last I checked, their savings account interest rate was over double of their next closest competitor. So, huge difference. And this is the rate that you get on an ongoing basis. It's not one of those promotions that you see some other banks use where it's only for a short period of time, which I kind of find annoying because I'm not going to be switching from bank to bank every month when some new promotion comes out. So this way, I keep it with one bank and I know that they're always going to have one of the top interest rates in Canada. So to get the free high interest rate savings account and a 1-year free subscription to Canadian Money Saver magazine, just go to buildwealthcanada.ca/EQ. That's buildwealthcanada.ca/ the letter E and the letter Q. Open up the free account. And once you're done, just forward any email that you get from EQ to bonus@buildwealthcanada.ca. And I'll send you a coupon code that gets you a free 1-year subscription to the magazine. So that link again is buildwealthcanada.ca/EQ to open an account, and then forward me any email from EQ to bonus@buildwealthcanada.ca, and I'll email you the free code to the magazine. All right. So enjoy. I appreciate you supporting the show in that way as well. Like I said, I use Canadian Money Saver magazine. I read all the time. I use EQ Bank all the time. So definitely I'm recommending something that I personally use myself and that I really believe in, and I really appreciate them agreeing to be sponsors of the show since I'm a big fan of theirs. So thank you as well if you take advantage of that offer. And now let's get into the episode. All right, Sean, welcome back to the show.
Hi, Cornell. It's wonderful to be back and to be chatting with you today.
Yeah, you too, Sean. So for anybody that hasn't heard the episode from the last time you were on the show, can you tell us a bit about yourself and your mortgage burning story?
Yes, definitely. I'd be happy to. So here I was at age 24 in Toronto, and I was looking for a property, and the real estate market was competitive. It actually took me 3 years to finally find my property, 3 failed offers on different properties. But lo and behold, at age 27, I found myself a homeowner in Toronto. But I didn't want to have this mortgage basically as a ball and chain for the rest of my life. So I set myself the goal of paying off my mortgage as soon as possible. So the funny thing is I signed up for a 5-year fixed rate mortgage, but I actually managed to pay off my mortgage in only 3 years by age 30. So probably should have signed up for a shorter mortgage. But anyways, can't complain. I got my mortgage paid off. So how did I do that? I basically did that in a couple of main ways. I lived as frugally as possible during those 3 years. And I also earned a lot of extra income in terms of side hustles. So I was a personal finance journalist, did money coaching, and worked a part-time job at meat department at Northville Supermarket. So basically did everything I could to bring in extra money. And with all that extra money and savings from living frugally, I just made a ton of extra payments on my mortgage and totally maxed it out. And I was able to pay it off in 3 years' time. So my story ended up getting a lot of coverage, but how did everyone hear about it? Well, it was kind of funny. A reporter from CBC, Sophia Harris, actually called me up out of the blue one day and said she was doing a story on super savers and she was interested in getting some of my tips in order to save money. But I basically just ended up mentioning to her, I had this goal of paying off my mortgage as quickly as possible. And she seemed to be interested. So the interview kind of shifted to that. And before I knew it, we had a conversation like for almost half an hour about that. And she said, well, CBC is thinking about turning two of these stories into a segment for CBC's National. So let me get back to you in a few days and see if the producers are interested. So lo and behold, I get a call the next evening and she says, okay, we want to film your big mortgage burning moment. So I was just going to have a small party with my family, maybe with like 4 family members, my mother, father, and 2 sisters. But then I'm like, well, I need to go all out. So since CBC's going to be at the party, so I invited all my family and friends and had a big party with over 30 people, held my mortgage papers up in the air and lit them on fire and burned them for the cameras for CBC. And if you've ever seen my story online anywhere, you've probably seen the iconic photo of me burning my mortgage papers. So because of the goal that I set myself and the fact that I was willing to do what it takes, I was able to pay off my mortgage in 3 years by age 30. So it was definitely a pretty amazing moment. I like to joke it's the most amazing moment till I get married one day.
Yeah, the burning was it looked pretty amazing. I remember seeing the story and just the burning of the papers. It's pretty, it's a lot more fun than what I did. I just took what I did is they when they sent you those papers that confirmed that it's all paid off and that you don't owe anything else, they send you that letter, right? And so
Yes.
I did like a screenshot of that. I was like, there's the and I'm just smiling looking at that. But you're burning the mortgage thing is a lot better. I totally should have celebrated a bit more because that was yeah. Well, no, that's awesome. So after reaching that milestone of paying off your mortgage so early, and then really never, at that point, you never had to worry about mortgages ever again if you didn't want to. What
Exactly.
made you decide to actually become a mortgage broker? It's like you finished paying off your mortgage and then you jumped into becoming a mortgage broker. How did all that come about?
That's a great question. So after I burned my mortgage, I ended up writing a book because something on my bucket list was to write a book. And the CBC reporter, I happened to mention to her that I wanted to write a book, and she said, "Oh, you should definitely write a book about paying off your mortgage. Like, I would want to be the first one to cover it." So I'd be foolish not to write a book then. So anyways, to make a long story short, I ended up writing my book called Burn Your Mortgage and ended up selling great. And I kind of got the whole media attention for a second round after that happened. But what ended up happening was I just kind of wrote a general book with advice on buying a property as well as getting a mortgage, becoming a landlord, stuff of that nature, basically getting your finances in order to buy a property. But it was just general advice. So a lot of people were reaching out to me looking for specific advice, whether it's on real estate or mortgages. And my sister's a real estate agent, so I was happy to refer people to her who are in the GTA area. But in terms of mortgage brokers, I didn't really have a trusted source, and I knew some brokers that I thought were decent brokers. So I was sending them potential leads their way because I wanted to help out these individuals because they read my book and they were looking for genuine advice and assistance with their mortgage, which is most likely the biggest debt of their lifetime. So yeah, I was referring them to people that I thought were good mortgage brokers. But what ended up happening pretty much every time was that the brokers wouldn't get back to them in a timely manner and or they weren't able to help them. So I was just kind of disappointed because when I would make media appearances, I would recommend, contacting a mortgage broker, but it didn't seem like I had a reliable source. And it wasn't, I worked hard for my reputation. So I didn't want to be referring them to people that weren't really able to deliver what, the benefits of a mortgage broker that I go through in my book. But yeah, they just weren't reliable sources. So I was just like, well, one day after this situation happened, these brokers had the tools they needed, but they just weren't choosing to use them. So one day kind of a light bulb went off in my mind and I'm like, well, why don't I just become a mortgage broker myself? I have a background in finance. I have over 10 years experience in the financial industry. I have these people reaching out to me looking for honest advice. They want somebody who's going to be like a trusted advisor. They don't want to be sold on products. And that's totally myself. I'm not a salesperson or anything like that. So I said, why don't I become a broker myself? And the fact that I had my mortgage paid off, I could take a bit of a risk in terms of my career because being a mortgage broker, you're compensated by basically a finder's fee from the lender. You don't get a salary or anything like that. So certainly if I had a mortgage to pay, I would definitely think twice about going into this career. But, with my mortgage paid off, I could afford to take a bit more of a risk with my career. And I was passionate about helping Canadians. I just didn't want to write general articles with advice. I wanted to actually be helping them hands-on with their mortgage. So that's kind of what encouraged me and inspired me to become a mortgage broker. So I signed up for the course, and when I do various speaking engagements all across Canada. So for example, when I was going on the train to Kingston, Ontario for a speaking event, and when I was flying to Vancouver for another speaking event, I was just reading the mortgage broker manual and studying that every spare moment that I got on the bus rides home every day, and then went ahead, wrote the exam, got over 95%. And then at that point in time, I'm like, okay, I'm all in. So handing my resignation at the pension consulting firm and the rest is history, and got licensed as a mortgage broker. So yeah, it's been great so far, and it's such a rewarding experience to be able to help Canadians hands-on. And yeah, I'm really happy that I chose this career. It's very rewarding.
For sure. That's really great. Yeah, I remember when you were on the show last time, we talked about how you became financially independent as well, right? And so it's nice that there's a mortgage broker out there, where you're already financially independent. So it's not like you're just doing things for the money because you need to pay the mortgage, or you need, or you have some debt you have to get rid of, right? So, I mean, yeah, I'm sure like the money is a component, obviously, but it's not like that's your main driving factor, right? Because you're already financially independent. So it's nice, I think, to have a mortgage broker that's focused on that, as opposed to just getting the most clients possible for the biggest possible mortgage amount so they can make the biggest commission possible. You know what I mean? There's a bit of I could see there being some conflict of interest with some mortgage brokers, right? And it seems like you don't have those conflicts.
Exactly. I mean, I've heard like somebody's mentioned a con of mortgage brokers is that some brokers will do, whatever it takes to, get the mortgage to fund because they want to earn the income, or they'll even encourage people to perhaps switch lenders when it might not make sense. But I'm honestly looking out the best for my clients, and I don't have a mortgage myself, so just don't have that same level of pressure to make a sale if it doesn't 100% make sense for the client. So I guess I'm different than a lot of brokers out there. For sure.
And I mean, I imagine most brokers, they have a mortgage, but people, when they get a mortgage, they don't always want to have a mortgage. They want to pay it off eventually too. And so I think that's neat too, where you can give people a bit different of a perspective, because you're a mortgage broker that actually was able to get a mortgage and then successfully pay it off very, very quickly. So for somebody that has similar ambitions, you can actually give them some really good, tips and, suggest some optimizations to be able to reach that goal quicker. And you've done it yourself. So it's not like you're just giving them some theory you read in a book somewhere. You've actually, done it, right? So I think that's awesome how you've kind of gone through that whole cycle, right, of getting a mortgage and then paying it off. And and I think there's a lot of, I've read your book, we've talked before, you've learned a lot going through that process. And I would argue that most mortgage brokers don't have that experience, right, because most mortgage brokers still have mortgages. And I think you've got a really good, good kind of thing that sets you apart from everyone else. Sean, when we first started talking about, having you back on the show, I got pretty excited because it's always fun to learn some hacks on how to get, the lowest possible mortgage rate, especially from someone with actual insider knowledge within the industry like yourself. But before we get into that, can you tell us if getting the lowest rate doesn't necessarily mean that you're getting the best possible mortgage, or is it really just all about getting the lowest rate and that's really all there is to it?
Sure, that's a great question. And usually whenever a client calls me, it's all about, what's the lowest rate that you can get me. But as I like to say to my clients, the lowest mortgage rate can help save you hundreds, but the wrong mortgage product can cost you thousands. Now, what do I mean by that? Well, in terms of looking for a mortgage, there are several features that you want to care about, and mortgage rate is just one of them. I mean, it might not necessarily be even number one on your list because there are so many other things that you should be concerned about. And mortgage rate is just one component. Like, depending on your financial situation, other things might matter. So what are some of these other things? Well, to make it easier to explain, I have this thing that I call with my clients. It's basically called the 3 mortgage Ps. And the letter P is basically like an acronym. It stands for different things that you should care about in terms of your mortgage. So the first thing what the 3 Ps stand for are prepayments, penalties, and portability. So first of all, when people are looking for a mortgage, they usually care most about the mortgage rate. But if you're somebody that wants to pay off their mortgage sooner and you're motivated like myself, then it definitely pays to get a mortgage that has generous prepayments. So what I've heard from a lot of clients is that they just assume all lenders have the same prepayments across the board, but that's not necessarily the case. And oftentimes the prepayments are different from lender to lender, product to product. So for example, some lenders might offer you 10-10 prepayments, which means that you can make a lump sum payment of 10% a year and increase your mortgage payment by 10%. Or some lenders offer you 15-15 or 20-20. And some lenders let you make the lump sum payments any time on your regular mortgage date throughout the year, and other lenders are more restrictive. They only let you make that lump sum payment on your anniversary date. So it really pays to have a great mortgage broker who can ask those questions and find out if your goal is to pay off your mortgage sooner. And that way they can match you up with a lender and mortgage product that makes sense. I mean, if you have all this extra cash flow and you want to pay down your mortgage sooner, perhaps it might make sense to go with a lender who has a slightly higher rate but more generous prepayment privileges, because those extra prepayments go 100% towards principal and you'll save more money in the end. So again, it makes sense to work with a good mortgage broker who will ask the questions. So the second P stands for penalty. And when people are shopping for a mortgage, penalties are probably the last thing on their mind. They're more concerned about, as you said, the mortgage rate and even the prepayments. But people, when they're signing up for a mortgage, they're not thinking about breaking their mortgage. But that's something they need to seriously consider and think about the likelihood of them breaking the mortgage later on, because some mortgages can come with very costly mortgage penalties. And if you have to break it later on to sell the property or even refinance your mortgage, it can be very costly. So in terms of penalties, typically with variable rate, it's just 3 months of interest you'll pay as your penalty. But with fixed rate, it's the greater of 3 months of interest or the interest rate differential, or IRD. And again, I go into this in my book, but essentially the IRD looks at the lender's posted rate and looks at your current mortgage rate and does a comparison, and then the lender calculates your penalty based on that. And nobody really takes the posted rate, but somehow lenders are allowed to use that to calculate your mortgage penalty, which doesn't really seem right, but that's just the way it is. So with a fixed rate, your mortgage penalty can be very costly. And as mentioned, nobody has a crystal ball and they can't predict whether something will come up, a life event will come up, they'll get a job opportunity or whatnot, or they could lose their job and they might have to kind of refinance their mortgage, or they might get into credit card debt. But it's just good to kind of have that option if you think that would be a possibility. So, it's good when you're signing up with a lender to consider the mortgage penalties. And some lenders on the fixed rate side, the monoline lenders, which I'll get into later, or the wholesale lenders, as I like to call them, they have lower penalties for the fixed rate products. So if you think there's a chance that you could have to break your mortgage, then definitely worth considering signing up for a lender like that. And the last P is portability. So let's say you decide to sell your property and move to another property during your mortgage term. Well, many lenders allow you to port your mortgage with you. So that basically means take your current mortgage with the current terms and interest rate and move it on to the new property. And you can even blend and extend, which means if the property is more costly, you can get a new mortgage for the difference in mortgage amount that you would need and still keep your existing mortgage. But it's important to understand that just because a mortgage is portable, that it's not 100% guaranteed that it can be ported over. Like the lender might not like the product for the property that you're buying, the new property that you're buying for whatever reason, and they could say no to the port, and then you have to pay the penalty. There's also a certain time frame where you have to port the mortgage. So you basically have a time frame where you need to buy and sell a property within this time frame. And if you're somebody that doesn't like being tied to some sort of time frame and you want to take your time in terms of buying and selling, then perhaps porting isn't for you. So to make a long story short, it just helps to have this information up front so you can make an informed decision. And yes, a good mortgage broker will ask you these questions about your short and long-term goals so that they can match you with not only a good mortgage rate, but a mortgage that has all the features and is essentially the best mortgage for you and will work for you for the coming years.
For sure. I think people usually don't plan for canceling their mortgage, right? Because you're like, oh, well, I'm going to be living here for a long time. But I know, at least for ourselves, we've had, I feel like with almost every house, with every house we've bought in the past, the story was always, oh yeah, we're going to live here long term, but then life happens, right? Usually I think it's a job thing, right? But sometimes it's other things like, we want to be closer to family, things like that. And so then these things become really, really important. And I mean, I can see someone getting in a tough situation where they have a mortgage where, it's not portable. They maybe have it may really have really bad penalties for canceling. And then let's say they get a job or their job asks, they get fired and they have to find another job and they can't find one nearby and they have to move, or they have to take a temporary assignment as part of their job that's somewhere further away. And maybe it doesn't make sense to, I don't know, with my wife and I, we lived in Halifax for a while, for example, as a temporary job thing, right? So, I mean, imagine saying, okay, well, we're not going to buy a house there because it's only temporary, but what do we do with our there's all these kind of complications, right? And so even if you get relocated, maybe it does not make sense to buy in the new location, right? Like, I mean, in our case, we rented it out, but I mean, it's nice to have all these options and not be looking at a fee that's thousands and thousands of dollars because you picked the wrong mortgage product. So, I'm really glad. Really glad you bought those, because I remember being really thorough with this when we had our houses, and it helped us out a lot having these, sort of good terms in terms of the mortgage, and it was more than just the rate, So no, that's great.
Yeah, you wouldn't. I've heard of some people even turning down lucrative job offers because their mortgage penalty is too high. So certainly, I would want to set up my clients powerfully so that they don't have to do something like that, because that's really unfortunate.
100% for sure. I mean, you cut your flexibility, right? And it's like, you will take this job offer, it's a good opportunity, but if I have to pay thousands and thousands and thousands, and then there's moving expenses and all the, all that stuff, maybe I won't take that opportunity. And I mean, like you said, that's definitely sad. So those are three critical components for sure. I personally found them to be very, very useful things to consider as well. Back when we had our rental property and our and then with our primary residence when we had a mortgage. But with that said, obviously people still want the lowest possible mortgage rate as well. So what are some top elements or tactics that can help us get the lowest possible mortgage rate?
Well, great question. Well, obviously there are, what lenders look at and when qualifying for you for a mortgage is your income, your down payment, your credit score, and the property itself. Now, most people know that, the better my credit score, then I can qualify for the best mortgage rates with people. So that's a pretty obvious tip, but I'm going to kind of talk about like how lenders actually price their mortgages in terms of their rates, because if you just see these advertisements out there for mortgage rates and see these low rates, a lot of the times it's for a mortgage rate that you might not qualify for. So I just wanted to give the listeners and watchers of the show here basically some insight to understand how mortgage rates are priced. So because certainly there's, fixed versus variable, there's a difference in the interest rate there, but there's actually a difference in interest rate depending on several factors. So just wanted to go through them now. So let's say you're buying a principal residence versus a rental property. There are different interest rates in terms of mortgages on them. I mean, I guess it's to do with the risk level, but essentially with rental properties, there aren't as many lenders that offer mortgages for rental properties. So there's less competition as well. So when there's less competition, the rates tend to be higher. So yes, if you're buying a rental property, the mortgage rates are typically higher than a principal residence with the same lender. Another factor is loan to value. Now, loan to value is a fancy way of saying what percentage is the mortgage versus the property's value. So let's say that a mortgage is $400,000 on a property that's $500,000. Well, that's an 80% loan to value, using that as an example. So typically when you put down less than 20% on a property, you actually get the very best mortgage rate. Now, again, using conventional wisdom, you would think, well, the more I put down on a property, I should get a better interest rate because I have more skin in the game. But that's not actually how it works. The government basically did a bunch of rule changes several months and years ago. And basically the bottom line is that when you put down less than 20%, CMHC is basically backstopping the mortgage, and it costs less for the lender in terms of getting protection. Like they don't have to go to the mortgage-backed securities market in order to get financing, yada, yada, yada. But basically the bottom line is that if you put down less than 20% on a property, you get a better mortgage rate. But then keep in mind that you have to pay like CMHC fees, mortgage default insurance fees, whatever you want to call them, on top of that. So there's definitely a cost involved. But yeah, when you see those really great rates out there, it's more than likely for high ratio mortgages, which is when you're putting less than 20% down on a property. So just an FYI, when you see those great rates from the different lenders, it's probably for a high ratio mortgage. But if you're not putting down less than 20%, if you have at least 35% down payment or 35% equity in the property, you can typically get as good of an interest rate as the high ratio people. Maybe not bang on, but generally when you have at least 35% equity in the property, that's kind of the amount of equity that you need to get the best rate with the lenders. So just wanted to give the listeners a bit of background information on that.
Gotcha.
Also, mortgage rates.
Sorry to interrupt, just to clarify. So is it worth for somebody looking for a mortgage, is it worth for them to go through the exercise, for example, with their mortgage broker to say, okay, I can either put the 20% down or more, and here's the rate I can get in that scenario. Or option 2 is I can put down less than 20%. Now I'm going to have to pay the CMHC fees, but here's the lower rate I may be able to get. And then kind of crunching those numbers, or or having like yourself, the mortgage broker, crunch those numbers and say, okay, in your scenario, here is sort of the optimal solution if you're looking to kind of pay the lowest costs, right? Because it's no longer just about the mortgage rate, right? It's about, well, you're also paying CMHC fees, so maybe those offset the lower rate that you're getting, right? So, I mean, is it worth going through this exercise for people, or is there kind of like a hard and fast rule that's the correct rule 99.9% of the time?
Yeah, I mean, if you have a sizable down payment and you have that option, it's definitely worth having that conversation, because some people have more than a 20% down payment, but they're just choosing to put 20% down because their money is invested and they like to use it for other purposes. So yeah, definitely that's a good conversation to have with your mortgage broker just to see what makes the most sense. So yeah, that's a great point that you raised. Mm-hmm. So in terms of how lenders price their mortgages, also another factor is purchases versus transferring your mortgage versus refinances. Again, mortgage rates are priced differently than that. Typically, you'll get the lowest rate on a purchase, and then after that, like a switch or transfer when you're moving your mortgage over to another lender, typically you'll pay a bit of a premium on that. And then at the end of the spectrum is refinance, where you'll typically pay the highest rate on that because refinances are uninsurable. So it costs the lenders more money to kind of get the financing and backstop it that way. So yeah, there's different pricing in terms of purchase versus transfers versus refinance. And another factor is the amortization period. So if you're putting down less than 20% on a property, the maximum amortization is 25 years. But if you're putting down more than 20% on a property, you can go to an amortization of 30 years, which many lenders offer. But just an FYI, some lenders charge a premium when you go to 30-year amortization. They might charge you a higher rate. Depends on the letter, but maybe you could pay like 0.15 or 0.2% higher depending on the lender. And some lenders, it's the exact same rate. So, with the mortgage stress test, sometimes people need to go to 30-year amortization to qualify for the mortgage, but then sometimes they qualify for 25 years. So all depends on, how quickly you want to pay off your mortgage. And again, your broker can kind of have a conversation with you to make sure that the mortgage that you are choosing is aligned with your personal goals. And yeah, as I mentioned, the best rates are usually available with the high ratio mortgages. And yeah, I would caution the listeners when signing up for a mortgage, be careful when you're signing up for a collateral mortgage, because those are great when you're taking out a home equity line of credit. But when it actually comes to shopping around for a mortgage, your options are very limited. There are more options now than there were 2-3 years ago, because some lenders came up with something called a collateral transfer, which before this collateral transfer existed, you used to have to refinance your mortgage to move to another lender. But now with collateral transfers, you can move over your mortgage and you don't have to pay the higher rates of refinancing. But again, there aren't as many lenders that offer collateral transfers, so the rates don't tend to be as good as if you did a straight transfer. But that's kind of a way lenders are locking people down with collateral mortgages. And just a couple lenders off the top of my head that do collateral mortgages as opposed to standard mortgages are TD Bank and Tangerine. All their mortgages are collateral mortgages, and they can be great if you plan to take out a home equity line of credit. But just bear in mind that it's hard to transfer your mortgage and shop around when your mortgage comes up for renewal. So just make sure you understand that if you're signing up for a mortgage with any of those two lenders there.
Can you define what a collateral mortgage is, just for anybody that's new to that term?
Sure. So it's basically a mortgage with a charge registered on it. And it could be for more than your property's value, like up to 125%. And what the collateral mortgage basically allows you to do is it allows you to take out a home equity line of credit on the property. You're basically like putting the home equity line of credit in second position in the property there. With a standard charge, you wouldn't be able to do it the same way. So it has the advantage of having that home equity line of credit and being able to tap into the equity in the property. But the downside is that you have to pay expenses for switching lenders later on. And you'll more than likely, if you switch lenders later on, you'll more than likely not get as good of an interest rate. So if you're somebody that is planning to do home renovations and you want to take full advantage of the home equity line of credit, then certainly a collateral mortgage can make sense, but just be aware that you're limiting your options when it comes time to when your mortgage comes up for renewal and you want to shop around. There just are less options. So you'll more than likely pay a higher mortgage rate then.
Gotcha. So is collateral mortgage, are those the ones that are used when people do the Smith maneuver, where as you pay off your house, as you get more principal, your home equity line of credit goes up because you're basically owning more and more of the house, and then you're able to take that money out of your house as a loan and then invest it or use however you see fit? Is that what we're talking about here?
Yeah, that's one part of it. Mm-hmm. The other part is that the mortgage is readvanceable. So what that means is that when you pay down the principal on your mortgage, the line of credit limit is increasing. So right. Let's say you made a mortgage payment of $2,000 and $1,000 of that goes towards principal, and your home equity line of credit is at, let's say, $50,000. Well, then it becomes $50,000 and $1,000, and it keeps increasing. If your mortgage wasn't readvanceable, the home equity line of credit limit would stay frozen. So, you want to do the Smith maneuver. It's important to have a collateral mortgage with a home equity line of credit and one that's readvanceable. There are lenders that do that, like Scotiabank, MCAP, those are two of them. But yeah, there aren't a lot of lenders that do that. So again, it makes sense to work with a broker who knows their stuff, because they can help you set up with a lender that can help you do the Smith maneuver properly.
Gotcha. Yeah, we can maybe do another episode on Smith maneuver, because that's a whole nother animal that warrants an entire episode, just I think due to the complexities of it and all that. But no, that's good to know. So a lot of times, is it, if let's say I think a lot of people, right, they have their mortgage and then they like to have a home equity line of credit as well. For example, I know we used to have one just to use as an emergency fund, right? So we never, we had some cash as an emergency fund, but we also had a home equity line of credit just in case something totally unforeseen that's really expensive came up. And I remember we did that. Never actually ended up using it. Fortunately, didn't have to, right? But just as like a extra safety thing, would you recommend doing something like that, like having a standard mortgage and then having a separate home equity line of credit, because then you don't have to worry about how easy it is to transfer and all these kinds of things? Or do you think these types of mortgages, the collateralized mortgages, are actually better because it's kind of like a one-stop shop, right, where you get a mortgage and you get a home equity line of credit all in one?
Well, you can definitely set it up the first way that you mentioned, but you tend to get a better rate in terms of the home equity line of credit, like prime plus 50 basis points, prime plus 0.5% when you have a collateral mortgage. So if you're somebody that wants that as a safety net, then it totally makes sense. And you do like a readvanceable mortgage where the limit will keep going up. But just bear in mind that you're kind of, you're not going to get as competitive as of an interest rate when it comes up for renewal, and your options just aren't as much. But yeah, I mean, if you're planning to do home renovations and you like having that safety net, which, your equity is not doing you any good by sitting there in your property, like you might as well put it to use. So like, I'm all for it if you're going to use it for something that like is helpful for you, like emergency fund or home renovations or even buying an investment property. I'm all for that. But if you're using your home equity line of credit to go on a vacation or buy a boat, then I probably don't recommend that. So it all comes down to the use of funds. But yeah, I definitely think it's a helpful thing to have, and might as well take advantage of that equity in your property rather than just letting it sit there and do nothing.
Mm-hmm. That's great. Yeah, I mean, it's definitely an item on the menu, right? That's worth considering when you are deciding on a mortgage, because it might be a really good fit for some people, for sure. Now, Sean, before we go any further, I just want to make the show friendly for people that are just getting started off in this. You mentioned the term amortization. Can you talk about, for somebody that's never heard that term before or aren't exactly sure what that is, can you explain, both what that is and also what kind of impact does it have in terms of, what your monthly payments would be, how much total interest you'd be paying long term, depending on your amortization rate, that kind of a thing?
Sure. So amortization is just a fancy word for how long it takes you to pay off your mortgage in full. So the standard amortization is 25 years in Canada. So mortgage term is basically like 5-year fixed rate, 5-year variable rate, whatever the length of the mortgage contract that you have with the lender. But the amortization is like the total length that it will take you to pay off your entire mortgage. So if you make extra payments on your mortgage, your amortization will get shorter. But yes, but basically what it is, the total length of time that it takes to pay off your mortgage, you could do it's 25 years maximum. You're putting down less than 20% on the property. But if you're doing more than a 20% down payment, you can go up to 30 years. Now, 30 years makes it easier to qualify for a mortgage, but it will also be more costly in terms of the amount of interest that you'll pay over the life of the mortgage, because you're stretching out that mortgage by an extra 5 years. So in terms of Ontario, the mortgage broker has to provide you with an amortization schedule in terms of disclosure for the mortgage. So yeah, just have a look at the amortization schedule, and it basically shows how much interest you'll pay over the term of your mortgage, and that'll kind of give you an idea. But yeah, longer amortization helps with affordability, but just make sure that you know how much it's going to cost you in terms of interest, and just make sure you're comfortable with the extra interest it will cost you by stretching it out if that's something you'd like to do.
For sure. Yeah, the way I've always looked at it is the higher your amortization goes, the nicer it is on your monthly cash flow because your mortgage payments are lower. But then sort of the negative of that is that when you look over the 25, the longer period, you're going to be paying more interest, right? Because your mortgage is now going to spread over a longer period of time. Would you say that's a correct way of looking at it?
Yeah, that's a great way to just look at it in simple terms. So yeah, I mean, there's not really like a one size fits all advice for everyone. It really depends on the individual's own financial situation. So that's why it really helps to sit down with a broker and have this conversation with them, because one family's situation might make sense for 25-year amortization, but another family might make sense for 30 years. So that's why it's good to speak with a broker.
Yeah, 100%. Yeah, one tactic that I always really liked was, and I guess like you said, there's not one tactic that's perfect for everyone in every situation, but one that I always thought was pretty appealing is that if you have a mortgage where you have a long amortization period, so that your monthly payments are low, so that if something was to happen, like let's say you had a job loss or something of that nature, or maybe you work on a commission partially, right? And so your income is very volatile, right? And so some months you may make a lot, other ones you might not make that much. Then at least the amount you actually have to pay to the bank every month is relatively low because you have a longer amortization period, and so that can kind of help alleviate some financial stress. But at the same time, making sure your mortgage has really generous prepayment privileges. And so I think I'm trying to think back because it's been a while since we had a mortgage, but I think that might have been what we did, is we had a long amortization period, but we made sure that the mortgage, that our prepayment privileges were very generous. And so when we did have a lot of money to put into the mortgage to pay it off quicker, we could, right? So this way, I felt like, you're getting a little bit of best of both worlds, where on the one end, if something bad did happen, or let's say you did have a job loss, then you don't have this giant amount you have to pay every month, which can be helpful while you find another job. But if things are going well, then you have no problem making your monthly payments, but you can also put in a ton if you want to prepay your mortgage even quicker, right? And so I remember that's kind of one, item on the menu that I thought was worth considering, because I can see that making sense for some families for sure.
Yeah, that's the exact strategy that I use, Cornell. I stretched it out my mortgage to 30-year amortization, but with the prepayments, I was able to pay it off in 3 years because the lender that I went with had very generous prepayments. But I guess in order to do that, you need to be very financially disciplined. For some people, if they have like 30 years to pay it off, they might not be disciplined enough to make those extra prepayments. So I really think it depends on the individual. Some people would rather be tied to a shorter amortization to force themselves to pay those higher payments. But I just spoke with a client recently, and yeah, they went with really aggressive amortization, like a really short one, and then they run into financial difficulties, so they have to refinance their mortgage, stretch out the amortization, and pay the big penalty. So yeah, you definitely need to be careful in terms of setting that. It's an important decision.
Definitely. Yeah, no, that's really interesting. Yeah, it's like that. There's that whole psychological element too, where maybe having a short amortization does motivate you to pay that off, and it will prevent you. Like, I guess you have to know yourself at the end of the day and see what works well for you. But I hear you. I mean, I remember in your case when we were talking last interview. I mean, you were living alone, right? So you're single income, right, with a mortgage, right? And it's like, well, what if you lost your job and then that same month, the tenant moved out or something like that, or something like that, right? I mean, that could be pretty stressful, right?
Exactly.
But if you have a longer amortization period, your monthly mortgage payments are a lot lower, and so you may be able to fund that month, let's say, or two of trouble with maybe the cash cushion you have set aside, for example, right? Which would be a lot less stressful because you have set things up in that way. So that's awesome. No, that's good. I appreciate you sharing that. Now I've interrupted a bunch of times. Are there any other tactics that you want to talk about getting the lowest possible mortgage rate, or are we done with that one?
Sure. So one last thing I wanted to touch on is that there are two types of lenders out there. There are the banks and credit unions, which you're probably familiar with, the big banks and, local credit unions, which are provincially regulated. And there's also another category of lenders that perhaps you've heard of them. They're referred to in the media as monoline lenders, but I like to refer to them as wholesale lenders because that's a more client-friendly term to use for them. So essentially what these wholesale lenders are is that they're funded by the banks, and basically they're able to fund the mortgage for a lower cost. They spend less on advertising in branches because they don't have branches like the big banks on every corner. And they have really great mortgage rates, even lower than the big banks in most cases. And mortgage brokers have exclusive access to them. You couldn't apply to them directly. So if you want access to these wholesale lenders, which many people do, then that's the advantage of working with a mortgage broker, because you have access to all these lenders, and they usually have lower mortgage penalties and more generous prepayment privileges. And you're not paying that extra cost just to, basically I use the comparison, like, when you're going to the supermarket, you can pay the most expensive price for the brand name stuff like Tide laundry detergent, or you can pay for the no name stuff, and it might be just as good. And so basically I guess by going with the big banks, you're paying for all their like overhead expenses and advertising expenses, so you get a higher mortgage rate. But if you're opening to saving money on your mortgage, and then certainly wholesale lenders are worth considering. I mean, I went with a wholesale lender myself, First National, and didn't really hear of them a lot. I didn't see advertising on TV, but their customer service was second to none. And mortgages are kind of their bread and butter, and that's what they focus on. So I had really great experience with that. And certainly, if somebody's adamant about working with a big bank, then happy to offer them the best rates in terms of big banks. But if you're open to saving money, then, wholesale lenders are definitely worth considering.
So you said this is someone you used when you were doing for your primary residence / rental. That's who you went with?
Yes, I went with a wholesale lender because my mortgage broker presented it as the big banks are offering these rates, but if you're interested in saving even more money, well, there are these wholesale lenders, and you're just basically not paying the extra money for the brand name and name recognition out there. I was definitely happy to go with them, and generous prepayment privileges, low penalties. I mean, I got the best of both worlds. So I'm very happy about the wholesale lender that I went with. So always offer that option to my clients because I want them to be fully informed. And if they want to go with a big bank and they're adamant about that, that's fine, but just want to give them that information so that they can kind of make a educated decision for themselves.
Mm-hmm. For sure. Yeah, when we had our properties rather, that's what we did as well. Now, are there any negatives to picking someone like that over, going to your nearest big bank branch and just getting a mortgage there? Are there any sort of negatives with going with these types of lenders?
I mean, if you're a bit old school and you want to be able to visit a branch and I don't know, you enjoy the face-to-face time with a branch, then perhaps a wholesale lender is not for you. But with more millennials like wanting to do meetings online and not even want to do meetings in person, and yeah, I mean, even people in their 30s and 40s are like that as well. I mean, if you don't want to pay extra money for the upkeep of the branch, then I definitely think wholesale lenders are great. And yeah, as mentioned, they don't have the branches, but you can give them a call. They have great websites, and yeah, you're essentially borrowing money for them. So there's no added risk. I mean, they're giving you money for the mortgage. So if anything were to happen to them, which I've never heard of a wholesale lender running into problems or going under or anything like that, you're essentially borrowing money from them. So another lender would take over your mortgage and nothing would happen with your property. So basically you're getting a lower rate and better prepayments and lower penalties, and there's absolutely no extra risk to you. These wholesale lenders are funded by the big banks. So yeah, I mean, I definitely think they're worth considering, and they're a great option for people available exclusively through mortgage brokers.
That's a great point. I'm really glad you mentioned that, because I think some people will think, oh, well, I would rather go with a larger bank because the safety, security established, right? But and I get it if you're if you have $100,000 that you want to keep somewhere safe where they're not going to get hacked because they have the security infrastructure in place, and they've been around for ages, right? Then by all means, right, go with the big bank that has all of that. But in this case, you're not giving the bank money, right? You're actually taking money from them in the form of a loan. So it's not like someone's gonna rob the bank and something like that, because you're on the other end of the transaction where you're taking money from them. You're not putting your money in. So I think that's a really good thing to think about when people, because I can see some people saying, oh, I just like, do you find that with clients where they're like, oh, I don't know, I was kind of leaning towards going with a bigger bank because they're bigger and safer and all that, and it's like, and then you say, well, what do you mean safer, right? I mean, you're not putting money into, you're not putting something in some like vault or something,
Yeah, exactly. I mean, I respect what clients want. If they say that they want to work with the big banks, that's perfectly fine, but I like to give them this option because I want them to make a fully informed decision. So yes, I do get that. But I mean, in a worst case scenario, if something happened to a wholesale lender, which hasn't happened in my career being a broker and would be super rare, but what would happen would be another lender would just take over your mortgage, and your mortgage would stay would stay the same until the end of its term. So there's literally no added risk for you. So, if you enjoy paying extra just to have that brand name of the big banks, then go ahead. But if you want the lowest mortgage rate, the best prepayments and other options out there, then these wholesale lenders are definitely worth considering.
Mm-hmm. That's great. Yeah, I remember I was going through one, and I think while we were there, or not, I think while we were doing that, I remember that one, I guess, transitioned or got bought or something. I can't remember exactly. It was a long time ago, but basically, yeah, that one was closing down or maybe got acquired. But yeah, it was a really straightforward process. It's not like our mortgage got changed. It's not like we had to pay some fees. It's not like we had to really do anything. You just kind of get that legal letter that pretty much told us, hey, just so you know, this bank is now this. And I mean, you get that with insurance companies, I find all the time, right? Where they're like, oh, you're with this insurance company, now it got bought by this one, and so now our branding has changed to this, but your policy is still the same, and you're just like, okay, well, that nothing's really changed. So yeah, I've had a pretty positive experience, or like a really positive experience with it as well. But I see your point, right? I guess some people do just like to go in, just like with the financial advisors, right? They like to go in, they like to sit behind the desk, they like to talk to
big
someone,
names,
that kind of a thing. But of course, I guess as long as and if you're willing to pay a premium for that, fine. But I guess, yeah, keep in mind that you are paying a premium for it, because that face-to-face thing is not free. That office space is not free, in like the core business area, right? The desk they're sitting behind isn't free. Like everything costs money, right? So
exactly.
It's kind of like you want that extra premium one-on-one service face to face. I mean, that, in downtown Toronto, I mean, that office costs a lot of money. They have to pay that, and obviously you as the customer are the one paying for it. So yeah, I'm glad you brought that up. Are there any other mortgage sort of tricks or sales marketing tactics that the banks use that they don't want us to know about? Anything like that?
Sure. So in terms of their higher posted rates, you may have seen like some of these big banks have high posted rates, and you may be thinking, well, why would anyone advertise such a high posted rate like that? And the main reason is because they use those higher posted rates in calculation of, so they have this benchmark rate, like it's at 5.34% right now, but that's basically used in terms of the stress test for qualifying for somebody for a mortgage. So if you're putting more than 20% down, it's the greater of your contract rate, which is your mortgage rate, plus 2%, or the 5.34%. So that's what one aspect that the posted rate is used for. The other aspect is it's used in the calculation, as I said earlier, of the mortgage penalties. So it's something to be aware of. Even if you get a great rate with one of these big banks, they can use the posted rate against you in terms of the calculation of the penalty. Even though nobody in their right mind would take the posted rate, they calculate, if you're with a fixed rate mortgage, they calculate the penalty as if they could loan out the money at the posted rate, which makes no sense to me, but the rules, the way they stand, allow them to do that. So that's just something to be aware of about the posted rate that people don't usually find out about until they have to break their mortgage, and then they see the calculation and they're kind of shocked at the level of the mortgage penalties. So that's something important to be aware of. And yeah, it's also important to be aware of that when you're going to the banks, you're not getting truly unbiased advice. You really have to look out for yourself, because to be honest, like, when you go to the bank, they're just going to tell you about all the pros of their various products. They're not going to tell you about the cons. It's really about you to read the fine print and do your own research. They're not going to say, oh, like, better watch out for this penalty. We have a higher penalty. Like, if you're going to one of the big banks, they're not going to say, like, big bank A is not going to say, oh, we have a higher penalty. You might consider going with, our competitor down the street.
Right.
It's not going to happen. So you really have to do your own research and know your own stuff. And yeah, mortgages can be a bit complicated, so it's not always easy to read through the fine print and understand the information. I mean, just to find out if a mortgage is collateral or standard charge, they use this legal lawyer language, and it's not the easiest to find. So good luck reading through the mortgage contract and figuring that out. But yeah, you really have to look out for yourself when working directly with the banks. But yeah, I mean, in terms of the main advantage of like working with a mortgage broker myself is you do get that unbiased advice, because mortgage brokers have access to dozens of lenders. I have access to over 60 different lenders, and mortgage brokers don't have the big dollar marketing budget like the big banks. So we really rely on positive word of mouth referrals. So it's really in our interest and to place our clients with lenders that make the most sense for them, and it's going to leave our clients satisfied. Because yeah, if we just place them with a lender just for short-term commission, which would be really bad business, then it would come back to burn us later on. They wouldn't want to do business. The client wouldn't want to do business with us again, and they certainly wouldn't recommend our services to other people. So, and being a broker myself, I'm not like the big bank. I'm not tied to any one lender. So I just listen to what my client is looking for, and I can say the pros and cons of each product so that they can make an informed decision, rather than the big bank just telling you all the good things and you kind of have to figure out the not so good things with the product. And I like to use this analogy with my clients. If you were going to court, would you represent yourself? Of course not. So why would you negotiate directly with the bank? You're essentially representing yourself, and it's for the single biggest financial transaction of your lifetime, your mortgage. So it just makes a lot of sense for me for people to use a mortgage broker, because the services don't cost anything in most instances, and that way they can make a fully informed decision and hear both sides of the story.
Mm-hmm. For sure. Yeah, I remember that was what made us decide to go with a mortgage broker when we were looking for our mortgage. I was thinking to myself, why would I go with a regular bank where they will basically just give me access to their mortgages, and they're obviously not going to tell me anything negative about them because they're trying to sell me their mortgages? Or I could go with a mortgage broker who will basically shop around for me to find the best mortgage, and I can shop around myself as well. But then they will also do it for me, and then we can kind of compare notes. They can tell me some things to look out for. They can tell me the latest sort of rules and regulations, and there isn't that sort of conflict of interest where they're just trying to push their own product, in my face, right? In fact, you have, as you mentioned, you as a mortgage broker have an incentive to make sure the client is happy and that the mortgage is right for them, because you know that you're going to get business, from referrals, right? And and then when it's time to renew the mortgage, if they had a good experience, they're going to go through you as well, right?
Exactly.
You know what I mean? As opposed to you just having some boss that says, well, we're Bank X, and so you're only allowed to sell Bank X product, and basically put on your sales marketing hat on because you have to make only this particular mortgage look the best you possibly can. I mean, like, why wouldn't you shop around? So I remember for me, that was kind of the obvious solution, right? Is why would you restrict yourself to product from one source, right? It doesn't make any sort of sense to me.
It's a great point.
Yeah, no. So thank you for mentioning that. Now, the recent federal budget, it had some significant impact on some home buyers. Can you talk about what those impacts are, and when can we actually take action on some of these changes with the federal budget?
Sure. So to be honest, I was a bit disappointed with the federal budget, but it did have some help for home buyers. So the first major thing was that the limit in terms of the amount of money they can withdraw from your RSP as a first-time home buyer was increased for the first time in several years. So before the rule change, you could withdraw $25,000 from your RSP tax-free, but now the government upped it to $35,000. So if you're a couple, that's up to $70,000 combined that you can withdraw towards a down payment of a property. Something else that another rule change that they made just to recognize the current family situation of Canadians is that if you're somebody who's recently gone through like a marriage breakdown and you're divorced or separated, then you'll be able to access funds from your RSP under the home buyers plan as well. So previous to this budget, you weren't able to do that. You had to wait a number of years in order to do that where you weren't a home buyer. So that's a change that they've done, and it's a welcome change because I guess, Canadians are getting divorced and separated more often than when these rules first came out. So at least kind of recognizes the reality of the situation. Now, a second thing that the government came out with, which is kind of lacking in details, to be honest, we kind of know the big details, but a lot of the minor stuff is kind of still needs to be ironed out. So it's something called shared equity mortgages. Now, with a shared equity mortgage, there are things you need to be aware of in order to qualify for this. So you have to have a household income of under $120,000, and you have to have at least a down payment of 5%, because this is kind of a targeted approach to helping a certain segment of the Canadian population, so they have some sort of qualifying rules. So the shared equity mortgage kind of has a rule in terms of capping out in terms of the purchase price that you can get. So it maxes out at 4 times your annual income. So that means that you could buy a property up to $480,000. So yeah, I'm just thinking about in terms of where affordability is an issue in Toronto and Vancouver. I mean, 480 definitely doesn't go very far. Like, you'd be hard pressed to even get a condo for that amount of money. So I'm a little disappointed in the program, but at least, perhaps you could buy a condo kind of on the outskirts, maybe not in downtown Toronto or downtown Vancouver, but at least you can get your foot in the door of the real estate market and start building up equity. But yeah, there's some key details that are missing because the program launches in September, so they still have some time to get things together. So it's not out yet, but they haven't really released all the details of the program. We just kind of know the big details of that. And it's important to be aware that shared equity mortgage means that the government, the CMHC, is getting a stake in your property. So they're basically putting up some of the money in order to help you come up with a down payment and afford the property. So your mortgage payments are more affordable, but when you actually go to sell your property, you're going to have to give them a percentage of the appreciation of the property. So you have to ask yourself, do you really, some people use that appreciation of the property to move up in the real estate market. But if you have to pay off the government, then you might not have as much money when you sell your property as you had hoped. So you really need to consider the big picture and see if you're comfortable giving away part of the equity of your property. I mean, it can be a great way to get your foot in the door, but you just have to be aware that you'll have to pay off the government eventually when you do sell your property later on.
Okay, that's great. And then just a quick message to the listeners. If you're listening to this episode, let's say months or years after it's been published, then you're probably wondering, well, what the latest rules and changes are right now since we've actually recorded this episode, since obviously these mortgage rules are, they change and they're going to continue to change over time. So if you want to find that out, we've set up a special page where you can get a free consultation with Sean to get all those updates and questions answered and basically be up to date on everything before you buy your next house, or maybe it's your first house, or maybe you want to buy an investment property, or maybe you're renewing your mortgage. So if you do want to make sure that you are up to date sort of on these latest rules, you can get a free over the phone meeting with Sean. And so the page that we've created for you is buildwealthcanada.ca/Sean. So just SEAN. So that's buildwealthcanada.ca/Sean. So you can go there, you can sign up, and then Sean's been nice enough to basically, put his name out there, put his contact information out there so that you can get in touch with him and you can ask him questions, especially if you want to sort of get up to date on sort of these latest rules and if they apply to you and if there's any way you can use them to sort of, be put in a better situation. So thank you, Sean, for doing that for all the listeners of the show.
Oh, my pleasure. Thanks for having me on this episode.
Yeah, no problem. So now I'm a big fan of using a mortgage broker. I think that's come off as obvious, at this point, because I've mentioned, using it myself and it's great. Now I've consistently used a mortgage broker back when we had a mortgage, but, I can see some Canadians debating whether they should just go with their existing bank for the convenience, or maybe just Googling something like, lowest mortgage rates, right? And then trying to get some mortgage online with the lowest rate that they can find. Now, we've already talked about this a bit from the bank side. What are the pros and cons of each of these approaches? And are there any other approaches that I didn't mention?
Well, I touched on earlier about the issues of going with the banks. I mean, it's definitely convenient to visit your neighborhood branch, but the fact of the matter is you really need to look out for yourself, because they're just going to tell you about the products that they offer, and you really need to do your own due diligence and research the cons of their products and see if there's a better option out there. So many people are very busy and they don't want to spend hours upon hours of research to find a better option out there. So that's really a benefit of going with a mortgage broker, because they're basically doing that work for you, and they save you time and money as well. Now, as you mentioned, Cornell, another option is you could just Google lowest mortgage rates or use one of the mortgage rate comparison websites out there. And while that's fine and dandy and you can find a good mortgage rate, as I mentioned earlier, there are so many different factors that determine what mortgage rate you pay, the percentage of your down payment, the loan to value, whether it's a purchase, transfer, or refinance. You really need to be able to be searching in the right manner to find the lowest rate, because most likely when you see those super low rates out there, it's for a high ratio mortgage when you're putting less than 20% down. So you could be looking at and find all these great rates, but then you find that you don't qualify for them. So you're just wasting your time. So if you just want to save yourself a ton of time, and instead of doing the research yourself, have a trusted individual do it for yourself, then that's when using a mortgage broker makes a lot of sense, because the mortgage broker will basically do the research for you. And not only will they save you time, they'll save you money too, because they typically have access to all of the same lenders that you would find online. So really using a mortgage broker is a no-brainer. And they'll tell you about the pros and cons of the various products. It's not just a matter of you doing all the research yourself. I mean, I certainly encourage people to do due diligence, but if you want like a true financial picture and you want a trusted advisor who will ask the right questions and tell you both the pros and the cons of various products, instead of just staring at a computer screen and figuring out for yourself, that's when a mortgage broker makes a lot of sense. So certainly, I use a mortgage broker myself when I was looking for a mortgage. I went to the banks myself as well, and I used the website. So I went through all three. And speaking from personal experience, I can definitely say that working with a mortgage broker, I had the best experience. So very glad that I used the mortgage broker, and might be a bit biased by saying this because I'm a mortgage broker myself. But if I had to do it all again, I would certainly use a mortgage broker. So yeah, those are kind of my 2 cents on that.
For sure, yeah. After we used a mortgage broker, the first time we bought a house, there was no going back. We kept using a mortgage broker as well over the years. And kind of to your point, if you look at those comparison sites, it can be useful, and you use it to, let's say, find a rate that you find is a lot lower than at like the bank you were considering, let's say. But then now, let's say, you reach out to them and you start going through, you start jumping through the hoops with them. Well, at that point, you no longer have anyone in your corner, right? Because it's kind of like the same now as if you went into the bank, in the sense that
exactly.
They're trying to sell you their mortgage, of course. So they're not going to tell you, oh, our portability is actually not there, or our cancellation fees are a lot higher. I mean, they're not going to tell you that, because now you're talking to a salesperson of that mortgage, whereas
exactly.
you could have a mortgage broker on your side saying, well, actually, this lender does have these higher fees, and it does have, you know what I mean? So it's kind of like, why would you're really going at it alone. And why would you? It's not like like you said, mortgage brokers in most cases are totally free. It's not like you have to pay them out of pocket, because they get paid from the lender. And so why wouldn't you take advantage of that service? That's a good point for sure. And the other thing too was, I remember, like you, when we were looking for our mortgage, we used a mortgage broker, but I also did my own due diligence. So I did, just like you, checked out what the banks are offering, checked out what these mortgage comparison sites are offering. And I remember when I did it, I basically went to the mortgage broker and said, hey, look, here's the lowest rate that I've been able to find. Can you get me there as well with what you're offering? Because the way I thought of it was, well, if I can get the lowest rate using the mortgage broker that I can find on the internet, plus I'm getting one-on-one service with a mortgage broker, someone that wants on my side and wants my business and that kind of a thing, and as an option to all these other mortgages, why wouldn't I do that, right? And so for us, I remember that's the way things ended up going. Is I found the lowest rate. I asked the mortgage if they can hit it. They hit it. They gave us really good prepayment privileges, along like what some of the other pieces you mentioned. And I mean, it was sort of the perfect thing, right? Because we got the lowest rate and the other piece that you were talking about as well. And we got the one-on-one service, and I had someone in my corner, as opposed to just kind of going at it alone and trying to negotiate with a salesperson that does this professionally. So yeah, so that was kind of our experience, and hopefully that's helpful to some people. So Sean, you do offer a free consultation to Build Wealth Canada listeners. So like I said, I want to thank you for giving listeners of the show a way to get in touch with you and basically get their mortgage questions answered for free. So for anybody listening, if you do want some questions answered, or if you're already planning to buy a house now or in the future, or maybe your mortgage is coming up for renewal and you want some information to help you get the best rates and terms on your mortgage, you can chat with Sean for free by going to buildwealthcanada.ca/Sean. So that's just SEAN. So buildwealthcanada.ca/Sean. You can just enter your name and email there, and basically I'm going to send those over to Sean, and he can get in touch with you, and you guys can find a time that works well for both of you guys to have a phone call, and he said he'll be happy to answer questions that you may have. And that's it. So Sean, thanks so much for coming on the show again, and for making yourself available to help out all the Build Wealth Canada listeners.
Oh, my pleasure. Thanks so much for having me again, Cornell.
Awesome. All right. Take care. Bye. All right, I hope you enjoyed the episode. Don't forget to ask Sean your questions by going to buildwealthcanada.ca/Sean. That's just SEAN. He'll be able to answer them for you for free. And if you're looking for a mortgage or will need to renew your mortgage in the near future, definitely go to that same link at buildwealthcanada.ca/Sean to get his research on the best mortgages that he's been able to find all across Canada. And also so that you can learn what to look for before deciding on a mortgage. It doesn't cost you anything. And at the very least, you'll have someone that can help answer your mortgage questions. And you'll also get the mortgage checklist guide for free, so you can learn more about what to look for when deciding on a mortgage. So to get all that, just go to buildwealthcanada.ca/Sean and enter your email. Enjoy, and I hope you found all the information useful. And of course, if you haven't already as a Build Wealth Canada listener, don't forget to get that free 1-year subscription to Canadian Money Saver magazine, and also double that interest rate that you're currently getting in your checking account and savings accounts by signing up for free to my favorite bank and the bank that I've been using for years over at buildwealthcanada.ca/EQ. Once you do that, forward me any email that EQ sends you over to bonus@buildwealthcanada.ca, and I'll send you the coupon code that gets you a free 1-year subscription to Canadian Money Saver magazine. You'll also get that extra perk of unlimited free Interac e-transfers every month, and you'll know that you're getting one of the highest interest rates in Canada on your savings account. So that link again is buildwealthcanada.ca/EQ. Thank you for supporting the show in that way, and have a great week. All right, talk to you soon. Bye.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.